Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for July 11th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and Anthony Rocco, who is Chief Operating Officer at Dayton Freight Lines. Good morning, gentlemen.
Good morning.
Morning, Ken.
We're really glad to have you, Anthony. This is a timely time to have someone who's an expert in LTL and all things freight on the show, given some of the things happening in the news.
Yeah, well, thanks for having me. Appreciate it.
Would you mind, we always ask our guests just a quick 30 to 60 second bio and overview of your career for our listeners so that they can kind of get grounded in your expertise?
Sure. Like you said, I'm the COO at Dayton Freight. I've actually been at Dayton Freight for about 30 years. Only job I've ever had. Job I had before that was 5 lawns cutting grass. Started working the dock while going to college, and then got into sales afterward. Then did the traditional LTL, running different size service centers. So I moved around about 6 times in about 10 years. Came back and was liaison between ops and IT. Then was VP of ops for a number of years and have been COO for 3-4 years now.
Well, it's great to have you. As we've been having our internal discussions, we've been talking a lot about LTL is one of the really interesting facets of the freight market because there's still the regional versus national carrier dynamic. And it's a often misunderstood, I think, mode within the total freight ecosystem. So it'll be really interesting when we bring you back at the end to get into a discussion. So again, thanks for joining. I'm going to go to our key points of the week so that we can get back to Anthony with ample time for questions. And if you do have questions, drop them in the chat and comment section because we would love audience participation. So July 4th peak was more of a speed bump. At least we did see some peak behavior in rates. We were getting a little concerned there, but it does seem to have followed a very typical shape. Dean will show you the charts and graphs, but largely the exact shape you can count on. It typically happens. Dry van contract replacement rates down, active rates down. These are all good things. This is a market back in rectification mode. After a slow start, produce season is back on track. Year-to-date volumes almost identical to last year. Remember, it was super wet to start the produce season, some crop damage. Hopefully we'll see some continued strength there. PMI continues to lag a bit. 7th month of contraction after a 30-month bull run there. And then labor unrest. This is obviously what's dominating all of our analytics in discussions with media and partners. You've got sort of in a mixed order of importance, the strike on the Canadian ports. As of yesterday, there were 20 or so ships snarled up in that. We have yellow teetering on financial demise there. And then UPS, obviously the big one. That could potentially throw everything up in the air for us. So with that, I will turn it over to Dean, who will walk us through the market update.
Yeah, thanks, Ken. We'll do a quick market update today. For those of you that follow us, the long form version of this update will be published this evening. Just go to dat.com/market update. So let's start the show off with our look at the load to truck ratio and dry van. The market followed seasonal trends last week. Normally, spot market volumes drop about 39% in the week immediately after July 4. Last week, they were down 38%. That's going back as far as about 2015. So no surprise there in the lower volumes. Carrier equipment posts are down last week as carriers took time off, as they always do. Load to truck ratio down to 2.63 loads per truck. And in the produce market, as Ken said, after a very slow start, June volumes were within about 3% of last year, according to the USDA data that tracks the weekly number of truckload volumes of fruit and veg. In terms of truckload numbers, that's about 2,300 fewer truckloads of produce this season compared to last. So despite the strong finish, those volumes of produce weren't enough to lift the temperature control freight market out of its current slump. Spot market rates dropped last week. Carrier equipment posts were down. Reefer spot market volumes were down about 38%. Again, pretty much in line with what we normally see after the 4th of July. Load to truck ratio down to 3.83 loads per truck. And in flatbed, volumes were at the lowest level in 7 years at the halfway mark of the shipping year. Last week's volumes were down about 34%. Load posts in totality are about 77% lower than this time last year. Some pretty low load to truck ratio numbers, as you can see from the chart there, at 7.95 loads per truck. Having a look at some of our markets, we'll just cover some of the main ones this week. Georgia, outbound average spot rates in Georgia averaged $2.19 a mile last week. It's identical to where they were in 2019. In Atlanta, capacity was tight for the third week in a row, rates up 5 cents a mile to $1.88. Atlanta to Orlando, one of our busier lanes for dry van, paid carriers $2.63 last week. That was the highest since February, but still about 40 cents a mile lower than this time last year. Northbound loads to Elizabeth, New Jersey averaged $1.97. That was the highest since last October. Having a look in the Midwest, Illinois state average spot rates are identical to 2019 at $2.06 per mile. They were up 10 cents a mile last week. Chicago outbound loads paid carriers $2.01 per mile last week. That's up 9 cents a mile compared to the prior week. And in neighboring Joliet, spot rates were up 8 cents a mile to $2.03. In the refrigerated category, outbound line haul rates in California up 10 cents a mile last week to $2.63. They were led by solid gains in Stockton, where we've got a lot of cherries coming out of there at the moment. Spot rates up to $2.55 a mile, up 17 cents a mile in the last week. Stockton to Phoenix, one of the busier lanes for reefer carriers there, with paying carriers $2.13. That was the highest since last December. Nearby San Francisco, which is dominated by the Salinas fruit and veg market, line haul rates averaged $2.26 last week, up 3 cents. Long haul lanes, one of the ones we watch is a bit of a benchmark for long haul produce. Salinas to Hunts Point, New York, averaged $2.24 in June. That was the highest in 12 months and about 7 cents a mile higher than this time last year. USDA reported a slight shortage of trucks for watermelons and tomatoes in South Carolina last week, resulting in a 46 cents per mile spike in reefer spot rates in the Columbia market. They averaged $2.83. In flatbed, Indiana accounts for around 24% of the nation's steel production, mostly in the Gary, Indiana freight market. At $2.67, remember, folks, these are line haul rates excluding fuel. At $2.67, state average rates are 19 cents a mile higher than the prior week. They had been dropping for the prior 5 weeks. Outbound flatbed spot rates paid carriers $2.62 a mile last week. Short haul loads from Gary to Madison, Wisconsin, averaged $3.08. And in Atlanta, capacity tightened last week. Rates jumped 10 cents a mile to $2.59, led by some pretty solid gains on short haul loads to cities like Birmingham. It was paying carriers $678 a load, or about $4.61 per mile. And wrapping up our market update with our year-over-year look at spot rates, dry van line haul rates were mostly flat last week to slightly down. National average was $1.72. Spot rates are sitting about 26 cents a mile lower than this time last year. Produce season typically impacts dry van rates as capacity shifts to higher paying refrigerated produce loads. And in a typical year, dry van line haul rates would increase by 19 cents a mile from mid-April to this current week here, immediately after the July 4 long weekend. This year, they're just up 11 cents per mile, so around half. And in our top 50 lanes, which averaged $2.07 per mile per mile last week, they're about 35 cents a mile higher than the national average. In the refrigerated market, spot rates cooled last week, dropped by about 2 cents per mile at $2.07 per mile. National line haul rates in the refrigerated market are about 25 cents a mile lower than this time last year. And in flatbed, after being mainly flat in May and June, flatbed line haul rates have decreased by 7 cents a mile in the last month, following last week's 2 cent per mile decline. At $2.09 per mile, the national average flatbed spot rate is 39 cents a mile lower than this time last year, and sitting around 9 cents a mile higher than this time in 2017 and 2019. That's it for this week's market update. Remember, go to dat.com/market update. Our long form version of this report, including all of the charts, will be published later this evening. With that, it's over to Ken for the short-term forecast.
Thank you, Dean. So my job is pretty easy today. I'm going to run through our short-term forecasts. We always start with dry van, the first one of the week. The blue line is the historical 7-day weighted moving average. That just gives you a sense of where we've traveled over the last few months. And then we've got 4 forecast models. We've got the red one, which is our short-term forecast. It's more recent biased, if you will. The green is RateCast, our flagship model that's in all of our products. And then we've got a yellow and a gray, which are blended models, which kind of take into account different mixtures of forecast ensembles. Pretty much in agreement across dry van. And what does that mean? Typical slowing after the 4th. Ratecast is picking up on some late month strength coming back in. I'm not precisely sure exactly what that is, but again, it's not honestly a ton of movement. These models are what I would consider pretty well in line with each other. Let's go to Reefer real quick because it's pretty much the same story. A little bit of a flip-flop, though. This one has the blended forecast, the strongest of the four, with, again, some of that strength coming back towards, I don't know if it's expecting things to get choppy as we head to the summer, whether it's weather or just a delay in some of that seasonality, or maybe even a pull forward to some of the fall shipping. And then the other forecast models are pretty much in alignment with the gray and the red there. Let's touch on flatbed real quick. This is the most disagreement out of the entire model set. I don't know that I'm as pessimistic as that red line would suggest. We're seeing positive data coming out of housing and some other sectors, even though, as Dean alluded to and I mentioned as well, manufacturing is a bit sluggish at the moment. So this will be one to watch. Flatbed tends to follow a much less choppy and more kind of mountainous, if you will, seasonality, where you see this strong build in the spring and then it kind of wanes throughout the rest of the year. I don't know that you're going to see much of a shock outside of a major tropical weather event or two, or some kind of infrastructure-based event that would cause flatbed shipping to ramp. But with that, I want to turn it back to Dean and bring Anthony back to get to our question of the week.
Yeah, thanks, Ken. Anthony, we have about 1,000 questions that we wanted to ask you. Maybe we'll get through some of them, but let's start off with one of the easier ones. How's Dayton Freight handling the soft freight market that we're currently in?
Yeah, so we're definitely in a freight recession. We are down compared to some comps we've obviously had since the end of COVID. We grew tremendously in that 3-year period. So, we've been doing this a while. You manage your labor, you manage what you buy, and we're in a good spot. So it's not so bad that, we've had to lay off or do anything to that magnitude. But we've cut some hours here and there, and some guys are on 4-day work weeks and that kind of stuff. So managing hours and what we spend is pretty simple answer, but that's how we get through some recessions. We've been doing this a while and been through some ups and downs. So
just ground me, if you don't mind, Anthony. What is Dayton's mix in terms of internal line haul versus PT or contract trans to move the line haul portion of the LTL volume?
Yeah, we're about 2% of our overall line haul miles are contracted. So
oh wow, okay.
Yeah, it's very, very small. Being in a shorter haul market, sometimes it's harder to get some of those purchase trans. And then that's the times of the night we do it. About 80% of our freight's in the next day market. So it's just a little harder to do some of that. Our service, we pride ourselves on our service. And so we had a little bit more expense to move it ourselves, make sure it gets there. Yep.
One of the things that we've talked a lot about on our show is that COVID didn't just throw rates for a loop, right? I mean, there was a scheduling and imbalance and a ton of other ramifications in the freight market. Have you seen a lot of that start to go back to normal? Because I know with LTL, it's much more scheduled than live load and unload. From a full truckload perspective, it's a bit of a different animal. Have you started to see, or have you completely went back to pre-COVID normal in terms of the scheduling and balance?
Yeah, so I think probably last August we started to see a decline. We started to see a bump in seasonality February, March of this year, and then it declined back to those August levels. So though it's a freight recession, we've pretty much evened out. Like, it's pretty amazing. On Mondays, we have about the same bill count as we have for the past 15 Mondays. So it's pretty much leveled out right now, but it's definitely not increasing either. Size of the shipment is slowly going down. We're losing probably 3 to 5 pounds every couple months. So, since last August, we've lost about 30, 40 pounds in the total weight per shipment. So, so we're seeing this slow down, but like I said, we're in good shape. So we feel comfortable where it's going.
Has Dayton moved to dimensional weighting on the LTL side?
Yeah, so we actually were the second LTL carrier to add a dimensioner. So we added our first dimensioner in 2010, and our whole goal was from a pricing schematic on measuring pounds per cubic foot. We weren't necessarily trying to get the W&R revenue off that. So we have a ton of data. Currently, we have about 35 dimensioners, and we dimension about 60% of our freight a night. So we are bought into the dimensioner and what it tells us, because as you know, space taken up in a trailer is how we charge. So we need to be charging appropriately.
Yeah, Michael Ducker, who ran FedEx Freight for a long time when I was there for a few years, so we sell pace and space, and that's it, right?
Yep.
It's priority or economy, and it's how much space it takes up in the trailer.
Yep.
Anthony, on a show we had last year, one of our guests was from another LTL carrier. One of the things they said that came out of the pandemic was a much higher pounds per shipment, which I think you alluded to. But it was kind of in this in-between zone between what would normally go on a full trailer and what would go LTL. They were getting a lot more of this freight that was like 12, 13 feet long. It was fairly hard to handle in their typical LTL network because the shippers couldn't get as many truckloads as they would like to consolidate some of this type of freight. So when you talk about the average pounds coming down, is that sort of from a peak during the pandemic where you were getting a much higher volume of freight that was sort of bigger and longer than what you would normally get?
Yeah, so from the larger standpoint or the more weight, we definitely did see larger weight per shipment during that pandemic. And it did start coming down probably, 2021-ish. So we're about where we were pre-pandemic, and we're a little bit down from that actually. And then the length shipments, that's kind of a whole different animal. So the LTL sector started to charge essentially an accessorial for anything over 8 feet. We started doing that as well. We saw that business disappear. Then more LTL started doing it, and we actually saw it all come back. So it's pretty amazing that we handle about the same amount of shipments before and after our accessorial add. Which I thought to your point, some would maybe go on some type of milk run or something to go a different way, because it is really expensive, some of that. But pretty much we've seen the same volume on those overlength shipments.
So how are you? I mean, does Dayton handle a lot of volume shipments? And if so, has that changed and went back to pre-COVID normals? Because I know that was something for a lot of LTL carriers that did a lot of volume that's just skyrocketed when the truckload went haywire.
Yeah, so we define a volume shipment of anything over 10,000 pounds. So obviously that could be 10 skids or that could be 4 skids, depending on what it is. So our 10,000 pounds, when usually the truckload sector is a little more reasonable from a price per mile, we see our 10,000 pound shipments decrease. And then when the truckload sector gets busier, they start putting them back on LTL. So we have seen our 10,000 pounds in this freight recession, 10,000 pound shipments in this freight recession decrease as well.
So pivoting to some of the more timely topics, I obviously won't ask you to chime in on any competitors directly or anything like that. That's not proper. But there's obviously two major simmering disruptions out there. And I'll start with on the LTL side. Do you foresee that there's ample capacity to handle the P&D aspect of Yellow's LTL volume should they cease operations?
I do. I think because we're in this freight recession, I think there's a lot of capacity out there. I also think that if something does happen, it's going to be really bumpy for 9 to 12 months probably, absorbing that. You have to think about it. I mentioned earlier about managing labor and everything. So there's not as many drivers in the LTL network right now. So if that freight does proceed to come over, then there's going to be some time that it takes to figure out your labor and how you're going to handle it. But I do think there's enough capacity at this time. But like I said, it's still going to take 6 to 12 months to have it all kind of settle in, depending on where the freight is going.
So when you talk about capacity, Anthony, you're talking about P&D capacity as well as the line haul component?
Yes,
Combined?
correct.
Okay.
Yep.
What about on so my kind of working hypothesis for both UPS and Yellow is that pretty much exactly what you said. There's ample capacity on the customer interface side. I think the bigger impact for both will be on the line haul side, whether it's on the rail or with the interline carriers or with purchase tran. Yellow, being a Teamster shop, doesn't buy a ton of purchase transportation. I think it was like $750 million last year. As these other networks that do rely more heavily on the rail and over-the-road purchase tran, do you feel like there's enough disruption there if Yellow's freight were to be distributed to cause a noticeable difference in the over-the-road and intermodal markets?
Like I mentioned earlier, we don't buy a ton of purchase tran. I think you guys would probably be as good as anybody to answer that question. My only thought, though, is from the little bit of calls I get on people wanting to haul our business. It seems like it's increased significantly from a purchase tran standpoint. So I would think there's a fair amount of capacity out there. So, my brief interaction with truckload market, I would say it would kind of be similar to LTL. There'd be a disruption right off the bat. It'd be bumpy for a while, but after 6-9 months, it'd probably figure itself out. So there's enough capacity out there, but that would be my take.
It's interesting. Like your initial 9 to 12 months is longer than I would have expected, but it makes a lot of sense. I was trying to coach some folks that you can't take an academic approach, right? You don't just switch LTL providers overnight, right? There's a whole P&D aspect to it. There's even like the soft side of being a P&D driver, which is understanding your routes, getting the scheduling reconfirmed, understanding when the security guard takes his or her lunch, so you're not waiting. And like there's a P&D is a much different animal than what we think of in the truckload sector.
Yeah, so for us specifically, I totally agree. Like us specifically, we think we could take like 1,500 bills almost right away. But then that, if we end of 12 months have grown, 3,000 bills because of that other 1,500 takes a while to figure out to your guys' point from a P&D and line haul standpoint where it's going. You'll also see carrier service level drop. So it'll drop anywhere between 5 to 10% because they're trying to figure that out. They're not moving half loads. They don't have enough employees to move half loads. So there's a whole dynamic there that's going to take not probably a whole lot different than when we all came back from COVID. I know LTLs were turning their pickups off at noon because they couldn't take anymore, right? You're going to have some of that, and I think the customers who have some relationships with other carriers are going to have an easier time than the customers who are waiting till the last minute for something to happen. I just think that's that could be difficult for them to find that capacity that they need.
Anything else, Dean, before we get to some audience questions?
I just want to. A lot of our listeners might not be 100% aware of what LTL looks like, because we kind of throw these acronyms around, pretty frequently. I think everyone knows what truckload means, but what's a typical LTL consignment look like in your world? Sort of a regional LTL carrier.
Yes. So I always explain LTL as if I'm based in Dayton, Ohio, and I'm going to Sarasota for spring break. I get on a plane, I go to Atlanta, I move myself around, and then I get on a plane going to Sarasota, and we do the exact same thing, but we move freight and not people, which I'm very happy that's the case. Right. But it's a hub and spoke type of network. Like I said, we just have a regional presence, but most LTLs service anywhere between about 500 and 525 miles overnight. Our mix is about 80% next day and about 20% in 2 days. But yeah, our average shipment's about 1,200 pounds, 2 at 1.8 skids. So that's about what it looks like, and we can deliver anything from fertilizer to manhole covers. It can go a whole stretch of whatever it is. Right. So that's a little bit of what LTL is.
A lot of folks take it literally, because there's a lot of partial truckload freight that's moved, and they assume just because it's less than a full truckload, that's LTL, and that's really not the case. Like putting 20,000 pounds on a truckload and doing point to point live load and unload is not LTL, even though literally it's less than truckload, right? So,
right.
So we have to. Freight isn't easy sometimes for newbies to understand some of the nomenclature and certainly some of the acronyms, because we could talk for days and just use acronyms and abbreviations.
Yeah, and another way to look at it is we're like UPS, but we haul bigger packages, right? Packages on skids. That's another way to look at it.
Yeah. So we have a couple audience questions here. One around UPS. So we're actually not talking about the LTL division of UPS, which they did sell to TFI, right? Up in Canada, I think. Yeah. Right. Mm-hmm. We're actually talking about the looming potential Teamster strike. So the Teamsters contract in the United States with UPS expires on July 31st. There's been a lot of saber rattling. There is no agreement or even tentative agreement yet in place. And the Teamsters have voted internally to authorize a strike if an agreement is not reached by the end of the contract, which would be, again, August 1st. Again, if that were to happen, very large disruption up and down the supply chain, obviously. But that's what we're talking about here. What we're talking about is Yellow is in a bit of financial peril. They just yesterday received a little bit of breathing room from their lenders, but they have actually sued the Teamsters to allow them to make some operational changes, which the Teamsters are not happy with. So those are the two simmering labor issues that we're discussing here. We should have clarified that to start. I thought everyone was kind of up to speed on that, but bad assumption on my part.
And then T-Force obviously has to negotiate later this year. I think it might be September. I'm not sure, or TFI, however you want to look at them. So that's in there as well too. Just later in the year.
This is just a super naive question, Anthony? I'm sorry. Is Dayton a Teamster shop?
No, we're non-union.
Non-union. So I guess again, politics aside, this is not a political question. I'm just curious. This would be if Yellow were to disappear. This would be kind of one of the last major nudges away. I mean, the proportion of union to non-union LTL employees would tip almost completely to the non-union side, right? Wouldn't ABF be the last big national Teamster shop?
Yeah, ABF and T-Force, yeah.
So, I mean, how do you think about that from like a long-term view on union versus non-union in the LTL sector?
Overall view, I just really worry about what goes on at Dayton Freight, and we're into our culture. Every decision we make, we think about our employees and our customers, and I think if we just continue to have that thought process and keep our culture, we're fine who we are and we'll be successful. But there's some labor rules out there in the union that makes it a little harder to compete, and I think at one point they're probably going to have to really talk about that.
Yeah. Anything else, Dean? We're kind of coming up on it here.
Yeah, a quick question, Anthony. One of the questions we had from some of our staff yesterday: how long does it typically take to onboard a brand new customer? From sort of start to finish in the LTL world.
Yeah, that's a little bit. Question. Probably depends on the size. But once if you start a sales call and to the end of actually hauling freight, you're probably talking, depends on if they need some type of API or EDI interface and all that, which let's assume it's a larger customer, you're probably talking a month until you really start hauling some freight. Again, some of that can be pushed forward if, different things, but probably 3 weeks to a month.
Very interesting.
That's more what I was thinking, Dean, when I said it, it's at least 2 to 4 weeks before you get back into the roll of things if there's a major disruption. So are you seeing, I don't know if you can chime in on this, but are you seeing any shippers proactively start to diversify as a result of some of these looming labor and supply chain issues?
Yeah, so I would say we've had little to no freight that has been moved over. I would say we're just starting to, maybe to Dean's point, get some rate requests and get some bids of people, maybe starting a bit of a contingency plan, but that would be the first step. But we are not seeing a ton of freight move over as of now.
All right. We have one question about rates coming up anytime soon. These next 4 to 6 weeks in the truckload sector are pretty slow, right, Dean? I would expect, if I'm looking at my freight calendar in the back of my mind, right, the fake pumpkins and ghosts and Halloween decorations are probably on the water. The back to school items are either on the shelf or quickly arriving to forward stocking locations. And then things will be prepared for the full on retail Christmas rush coming across on the ocean here in the next few weeks to a month. So my expectation is by Labor Day, then heading into fall peak is when you'll start to see material strength in rates. But Dean or Anthony can correct me where I've erred there.
I think you got that spot on.
All right. So I guess we'll wrap. Any plugs, Dean?
Yeah, a couple of quick shout outs. As always, Sales Chat is on tomorrow with Dan Deegan, 11 a.m. Eastern, day-to-day Wednesday. I'll be on with Dan. Robert Rouse is on Landline tomorrow night, 7 p.m. on Sirius XM, channel 146, Road Dog Radio. On our current issue of Freightvine, our podcast with Dr. Chris Kaplis, Professor Chris Kaplis, sorry, we've got Jose Sheppy. He's our guest talking about the evolution of data science in trucking. Don't forget, DATCon is coming up October 10 to 12 in Houston at the Western Galleria. With that, it's back to Ken to wrap up the show.
Anthony, how can folks get a hold of Dayton if they want to move some freight or if they want to come drive for y'all?
Yeah, just go to www.daytonfreight.com and you'll be able to do both of those through the website. So,
Awesome.
Appreciate it.
Well, we really appreciate you having. I've learned a ton. Anytime I get a chance to brush up on LTL is a great day. So I really appreciate it. I hope everyone has a great week. We will be back next Tuesday at 10 a.m. Eastern. Maybe we'll have some more information on what's happening in some of these market potential disruptors. We hope you have a great week. We hope you have a safe week. We want to thank Anthony again for joining us, and we will see you back here next time. Bye, everyone.